And importantly, thank you everyone for dialing in today. So we've kind of got around about 900 people registered for today's call. We will be sending out kind of recordings and slide decks afterwards. But over the next 50 minutes or so, Robbie Tanjang, head of our global valuation advisory business, and myself, Phil Tiley, head of our performance and valuation data analytics, will take you through the latest set of the ODCE performance numbers, 25 ODCE funds in there, and within Altus we have that extensive valuation data set which we match up with those ODCE funds to provide added intel into the analysis of the markets. This webinar is kind of partly there as a market insight piece for our wider network of clients, but it's also partly a precursor to our one-to-one client conversations. Clients who are also members of NCREIF, where we replicate this analysis on a comparative basis. We look forward to carrying out those in the coming weeks. Before going to pass over to you, Robbie, just thank everybody involved in the process of getting all this information together throughout our advisory network, performance team working alongside me, but crucially our clients for giving us privileged access to their data, and NCREIF for pulling together some of the benchmarks that we're utilizing. Probably we always end off with a polling question, so let's get to that and you can kick off the analysis. If I can move my slides on we finished off last quarter.
Thanks, Phil. I think we're back to our international flavor edition this quarter, Phil. All right, so with my tropical, non-elegant Indonesian accent and your basically elegant and charming British accent, Phil. So I guess before we start, right, so I think that there's a Q&A, please incorporate them into the Q&A box, right? So we're trying to address it at the end. If it's not, we'll address it at the after the webinar, right? So to start the webinar, same as Kaneka, every single time we're gonna see what people expected, basically what people indicated the total unleveraged return will be in 1Q 2025, right? So I think the majority get it correctly again, Phil. I think 1 to 3%. Is it correct, Phil?
Yeah, with 78% there, it's no surprise the majority did get it right, in that we are seeing that kind of be the gradual improvement in returns in Q1. So let's get into that first slide here, showing that total return profile, although we should kind of clearly acknowledge up front that a lot has happened since the end of the quarter, especially with the announcement of that wave of tariffs on April the 2nd. But for now, and I know you want to get into that detail, Robbie, but for now, at the end of March, returns did come in a shade higher from where they finished off in Q4 of the last year. So coming in at 1.2%. And that return line continuing to move in the right direction. And within that, returns are now firmly back into positive territory. So we've been there now for 3 consecutive quarters, and that 2-year run of negative returns is now very much hopefully in the rear view mirror. There's also a very small amount of appreciation in that 1.2% return. We'll get into, so the market did reach an inflection point in that regard. We'll get into the detail of that shortly. But overall, for now, it feels very much like the market has entered a period of calm, especially when you compare this kind of 3 quarters runs of results with that kind of roller coaster ride. The returns have played out pretty much since the onset of COVID. So if you go to the left-hand side of this chart, that's almost 5 years ago, returns turning negative momentarily. Market then entered that post-pandemic upswing, but returns reached record levels of near 7% in 1 quarter. Most of those gains were then reversed out during the recent extended period of decline. We're thankfully now back into positive territory, but the market not notably really pushing on at this stage. I should clarify that what we're reporting on here is the pure real estate side of the Odyssey. There's no leverage, there's no cash in these results. It's how the pure real estate has played out. So let's move straight into breaking down those numbers and pack that performance series into the income and appreciation components of the return. The income here is in green, appreciation is in the red. And as a reference, what's newsworthy this quarter is how that appreciation piece just turned positive. So hopefully bringing to a close what has been an extended 10-quarter or 2.5-year period of decline in the market has endured. That began to taper off towards the back end of last year, but it now finally crossed the divide in the opening 3 months of this year. Quick word on the income return. That's steadily been increasing quarter on quarter. This is by definition income over capital. So as the capital base has declined, the return on income has effectively risen. So that improving metric is less about an improving numerator, the income itself, more about the declining denominator effect. And then on the appreciation side, we've been breaking the recent run of results into 3 distinct periods you see here. And so we can now tentatively add a 4th phase. The market is now potentially entering into it. I say that with an element of caution, given the uncertainty around the wider fiscal and economic environment, given these numbers are all pre-April the 2nd. But to total up the value movements to date, you have that initial pullback on values at the onset of the pandemic. That's when values were down just over 2%. This is then followed by 7 consecutive quarters of growth, during which 24% was added to property values. A lot of that is sector specific. Much of that has then been cancelled out in that kind of recent period of decline, 10 consecutive quarters of negative appreciation, values down over 20%. And now last quarter, the values are starting to edge upwards again. So on a cumulative basis, values are still down 5% on where they were since the onset of COVID. That's 5 years back. Next, what we're able to provide at Altus with that added insight with valuation data is that kind of dynamic of what's moving those property values, how much is down to pure economic fundamentals versus what might be termed the investor sentiment or the broader capital market influences. So broader regular listeners will be fairly familiar with the drill here. So first we transpose the red bar here onto the red line on this next chart and bifurcate that appreciation line in terms of what's termed the yield versus the cash flow effect. The yield impact is how much movement in values is really being dictated by the actual movement in valuation yield. So that's changes in discount rates and exit caps. The cash flow, the blue bar, is the impact on values from the change in the forward projected cash flows that are effectively being priced by those yields. Of note, this quarter, both the yield and the cash flow aspect of appreciation were now positive, so both accretive to value. Backtracking the narrative, the main pullback on values during this period of decline has been on the pure pricing side as yields moved out, primarily in response to the increased cost of capital, alongside some added investor caution towards certain sectors of the market. And that period of repricing, though, looks to have now run its course, and that yield impact, as I mentioned, just turning positive again this last quarter. That whole downturn has also coincided with a relatively fallow period from a cash flow standpoint. Thankfully, that metric, the blue bars, has also now moved back into the ascendancy in each of the last 3 quarters. And while it's not matching that continued level of upside the market was experiencing in the run-up to the pandemic, it's thankfully at least now back on an upwards trajectory. So Robbie, some green shoots emerging there, but neither metric really pushing on at this stage. And it feels almost as the market's in a bit of wait and see at this stage. So maybe your thoughts on those top level metrics.
Yeah, Phil, I think during during 1Q, right, there's much more positive news, right? So we were seeing in investor sentiment, we're seeing in transaction. Fundamental was generally strong, right? So there's an under allocation real estate by many investors. Overall, it feels like it's bottoming, right? So you can see as well, you kind of show earlier, Phil, the cash flow and the yield have trended positive this quarter, not for all property type, but for overall, right? So, and again, that is pretty consistent to what we see in market activities, right? So during the 1Q, right? So look at an interest rate point of view as well, right? So if you look at 10 years have started to move down actually quite significantly, right? So if you look at the beginning of the year, 10 years about 4.6, went all the way down to 4.2, sub 4.2, right? So in that sense, the momentum is actually in a very positive direction, right? So however, all this return fell was before April 2nd, the Liberation Day, right? So the world kind of changed after this, right? So Liberation Day definitely put a twist in the market, right? So we saw equity market globally drop. Granted, they have rebounded some sense, right? So, and look at 10 years, right? So it went seesawing, right? So the 10 years on April 2nd was around 4.05, shot all the way up to 4.5, then all the way back down to 4.17. Now it's around 4.3, right? So you can see how super volatile it is, right? So you show the uncertainty in the market. That definitely put a pause in the market, right? So from investor to tenant aspect as well. Fundamental are just still generally strong, right? So, but it's still definitely questioned, right? So when we talk to market participant, consensus is basically two property type that might have more impact, right? So industrial and retail, right? So industrial is basically what's the impact on tariff to the industrial, right? So on retail side as well, so what happened to the increase of recession, right? So we're going to talk about this more basically later on, Phil.
Yeah. But for now, it's important just to go into that sector variation of returns and say up to March. So on to this next slide. That takes us back up to the total return level. The most recent set of results are on the right-hand side. Sector returns are all color-coded here, so whether they sit north or south of the overall ODCE average. Up top, you have that confirmation of that slow and steady improvement in the overall ODCE total return, and returns generally ticking up across all sectors. The one exception is in that other grouping where there's self-storage. We saw a slight cooling off in that property type in the last quarter. But across all sectors, one step change to really take note of this quarter is how those returns have now turned positive in all sectors, offices included. In terms of the hierarchy, retailers have removed themselves back to the top end of the order with a pretty solid 2.1% total return income and appreciation. There's really then nothing to separate the apartments, industrials, and the other property grouping, all sitting at 1.3%. Offices still at the lower end of the order, but now with a positive 0.8% return, there is still some slight negative appreciation in that number. In terms of the dispersion of returns, that's what this bottom set of numbers is providing, where we're tracking the difference between the highest and the lowest returning sector of the market. That's really been closing in and continued to close in the last quarter. Last quarter, that's mainly as a result of that improvement in the office sector results and the fact that no other one sector is really breaking ahead of its stage. Next slide charts those results, and so you can see that overall very tight clustering of returns better visually illustrated on this slide, especially when you compare that recent set of results to where those sectors have come from. So this chart also serving as a reminder of the variances that we've experienced across the sectors throughout this kind of period. But for now, all sectors are increasingly in sync with one another. The market passes through this period of relative calm. And crucially, everything now sitting with returns above the line, so all back into positive territory. Let's now get into some of the detail of the makeup of those return series. So first off, the four groups looking at the breakdown into the income and appreciation time series. If you track back, you can see that here, that most of that write down at the onset of COVID was focused around the retail sector. That growth period was then dominated and really driven by gains in the apartment, but more notably, as our folks are aware, the industrial sector. All four sectors then enduring that period of decline, but to varying degrees. Slightly more contained for the retails and the industrials, a little bit more write down for the apartments, but clearly it's the offices that have been the worst affected. But if you go to the right-hand side of each of these time series, we're now entering that kind of momentary lull across the sector's returns. In each of these four groups are now mainly income-based. Most of the appreciation that there was in Q1 was within the retail sector. There's a slither of improvement for industrials and apartments, but offices still technically in a period of decline, although that level of decline is very much tapering off. Where offices are ahead, it's from an income return standpoint. The question is whether that income return is high enough to now attract investment back into the sector. Let's now layer in the yield and cash flow aspects to those appreciation time series. So further illustrating how almost all of that downside the market endured has been capital market related, those yellow bars below the line, with cash flows generally holding their ground through this current period, or that recent period of correction, with the exception of the offices, although that metric has also bridged the divide and turned positive for offices in the most recent quarter. Cash flows for apartments also did waver slightly at the start of last year with some effects of oversupply, certain parts of the market at a time of increased cost, putting added downward pressure on values, but that metric has also stabilized and returned into positive territory. Industrials clearly have had the best recent track record in terms of those cash flow gains, but that phenomenal growth is now very much tapering off and may continue to do so. I'll leave you to comment on that, Robbie, when we get into the detail of the industrial sector. But for now, it's the retails that are emerging as the front runner from a cash flow standpoint. They're also subject to less pullback on pricing, having already gone through a kind of period of pricing correction during the onset of COVID, pre the interest rate environment change, and before that having to obviously adjust to the competition from the online environment. Just to kind of round off the 5 main property types, so into that other grouping where we've also separated out within that the storage, which is the largest subgroup. Here, yields have pretty much stabilized for each of the last 3 quarters, which has allowed any improvement in cash flows, which is still pretty minimal, to feed directly through to appreciation. A bit more CapEx in the most recent quarter, taking the edge off those numbers in the storage sector. But across both this slide and that slide, now, despite all the variations we've seen playing out across these sectors, if you look to the right-hand side of these charts, there really is very little to choose at this point between the sectors and really minimal interplay in the makeup of appreciation in any of these sectors. But we do want to get into the detail of the latest set of results and analyze specifically what's played out within those yield and cash flow metrics. So just for the 1 quarter, just to recap, that's the appreciation numbers on the left-hand side. Offices down at the base, still technically in decline. That's mainly now as a result of just the ongoing capital expenditure, but also a slight pullback in terms of some yield increase there. Yields, as I said, did start to have a positive impact overall, and that can be traced mainly through to the apartment and the industrial sector. But what's really important to note, I think, this quarter are these blue bars here, the cash flow metrics, are now positive across the board, even for offices. If we run this chart over the 3 years, which takes us back to the onset of the period of decline, this then again confirms that it's that orange bar, the yields, that have been the major protagonists. They've been the root cause for that pullback on values across the board. Even if it's the blue bars, the cash flows that have been the variant between the sectors, it's the yields that have taken the values down. And in terms of that yield correction, by the time we get to the opening 3 months of this year, that's pretty much now run its course. And we can see here, when we look at those actual valuation yield levels, they're certainly leveling off in the first 3 months this year. So, Robbie, is that the sense that you've been getting looking at the valuation data?
Yeah, so we overall see stabilization in pricing, Phil, right? So for all sector actually, right? So you look at office, they've gapped out earlier, right? So then you can look at the kind of stabilizes, right? So as we're now seeing more activities as well in both leasing and transaction, and again, more and more back to the office, right? So in all the gateway markets, so New York, Seattle, San Francisco, that's why we see improvement on the office side. Even look at apartment, there's also improvement there, right? So part of it is transaction remain very competitive in some of the market. Overall as well, we all know the supply side, the new construction are declining quickly, right? So, and that provide tailwind for the commercial real estate in mid to long term, right? So as you kind of show earlier, Phil, the cash flow have improved all market, right? So again, this is kind of positive for the real estate.
Yeah, good. Thank you. Thanks for that added detail, Robin. Yeah, to your point, I mean, it is that cash flow piece that stands out as the positive for this quarter. So now accretive to values in all sectors. So just to interpret that piece, and many listeners will be familiar with our approach here, but just to explain, the bars here, alongside those cash flow effects, show the same store movements in 6 of the primary valuation influencing cash flow measures. It's not exhaustive. There will be other metrics that come into play. Bars then don't sum up to that cash flow effect on the left-hand side, but the color coding gives everyone a sense of what's having a positive or negative impact on those cash flow trajectories, supporting those improvements in value. So, point to note, It's still kind of quite a mixed picture here, but the net effect is more upside than downside, so there's more greens and reds on the card. In terms of contract rent, widespread improvements there, pretty muted for apartments. Industrials, the leader there with the largest increases, and that's where that spread has really been opening up between the in-place and the market rent. So some of those gains now being realized. Market rents are also generally improving, with the exception though of the industrial sector, and probably we can get in the detail of the market by market results within that, and it will be interesting with the analysis you've been running with our research team to see if recent turns of events may continue to halt that metric. In terms of the upside, those projected growth rates continue to increase, and pretty much across the board. The exception is other, where I say we've seen some cooling off amongst self-storage properties in the most recent quarter. But in terms of that growth rate, even then picking up there for the offices, although following that line down below, which is charting that over time, that's now rising from a relatively low base. On the downside, some cutbacks in occupancy, although those occupancy rates are still relatively strong. And then embedded in that operating expense ratio, that's the year one cost to revenue ratio and how that has moved out over the quarter. And it's still in the red zone across the board, so implying that near-term costs are still rising faster than near-term revenues. So while that cash flow effect is positive, there's still enough red on this card to still be mindful that we're not in a fully fledged upwards cash flow trajectory just yet. Sticking with the positive narrative and that improving trajectory, these charts look at the results from a slightly different lens. They show the proportion of values that are either increasing at a standstill or in the red have been lowered quarter on quarter. It's definitely an increasing positive set of results here for apartments, retails, and industrials. We've certainly crossed the divide. The majority of property values are now on the rise this last quarter, up to around about 60%. Offices also nearly reaching that crossover point with over kind of almost half the properties now seeing some improvement in the last quarter, but mindful that's not saying the quantum, but it's also mindful that we're coming off a relatively low base. But if we are starting to get to that turning point, then maybe as a lead to our polling question, Robbie, this kind of serves as a reminder of where values are now and how much correction the market has experienced. So the sandbars here are showing that kind of peak to trough, how much write down there has been in the current period of decline, and the purple bars where those values are now sitting versus where they sat kind of 5 years ago, pre-COVID. So office values down 40%, apartment values in the current period of correction down 20%, but they're kind of at parity, breaking even when you build in that post-pandemic upswing. Industrials, current period of decline, they're down, but they're still up 50% on where they were, and retail values are down 20%, having experienced a bit more of a setback at the early parts of COVID. And so that sector, while it's still leading for now, is still very much making up for those losses. So that maybe sets the ground for our question there, Robbie. So moving to that.
Makes sense. Yeah, our first poll, right? So basically, which sector will perform the best in the next 12 months? Apartment, industrial, office, retail, or other? Yeah, so we give about call it 30 second to 60 second, right? So Phil, what's your pick, Phil?
Okay, well, giving too many spoiler alerts. I know what you're going to tell me about the retail and the industrial sector, but there may be obviously some headwinds there. I mean, office is 40% down on where they were. Return to office, but it feels to me that I would put maybe my money on the apartment block there.
Yeah, that's a safe bet, right? So let's see the result. So yeah, basically correct though, Phil. So majority do pick basically an apartment, and they do pick retail as well. So 44% apartment and 32% retail. So I guess that kind of interesting, right? So but in terms of what people pick there. So
okay, well, thanks everyone for involving themselves in that polling question. We appreciate everyone's thoughts and inputs. Let's move now into the details of the individual sectors. I might skip that slide for time and move straight into the apartment sector. So Here we look back to that total return level, seeing how returns have shaken out on a geographic basis across the major metropolitan markets, ordered in the usual way from the west to the east coast. Start there down here, you can see the last 4 quarters. We've got the 1-year results, taking us back through the current period of correction, 3-year annualized numbers. These are all total returns, and then back into the prior growth period, taking us back to the onset of COVID, a 5-year annualized figure as well. The color coding is all relative to the average for the sector across each of those time periods. So that's the navigation in terms of the results. A bit of a shake up to the order this time round, in that we've been noting previously more of a setback amongst some of those West Coast markets. Q1 has reversed a bit of that trend. So those markets possibly through the worst of it. Seattle, San Francisco, LA in that kind of 1.5 to 2% range. Probably, I guess this may be all part of that revival of the gateway markets that we've been referencing in prior quarters. Gateway markets, certainly now, look at the last year, New York, DC, Chicago posting some of the stronger results, now joined by Seattle, San Francisco, in LA in the most recent quarter. So reversing that power shift that had swung in favor of the Sunbelt markets in that kind of post-pandemic growth period. So what's your take on that movement there, Robbie?
Yes, as we can see, right, we talk about it, the return of the gateway market. So that's how you see a positive kind of basic result in Seattle, San Francisco, Chicago, to some extent New York, right? So New York have been very positive the past several quarters, right? So Sunbelt continue to be less positive, to some extent negative on some. Part of it is the supply challenges, right? So you can see the red in Phoenix, Denver, Atlanta, and other, right? So other, there's a lot of the smaller Sunbelt market, right? So if you can see the next slide, right, Phil, there's a lot of them are positive cash flow. So I rent in Seattle, so I recently got an 8% increase in rent, right? So after minimum last year. So I guess some of that positive cash flow come from my paycheck, Phil. So that's going to confirm the stronger cash flow effect in Seattle, right? So I think a lot of cases is going to back to the office mandate from the tech firms such as Amazon, right? So while this overall, there's still kind of a spot for rent challenges and oversupply in some market, we kind of look at it, there's definitely a tailwind for this sector, right? So if you look at the new supply are declining fast, right? So new development are hard to pencil in, right? So high interest rate, the rent is kind of expected to grow in the near term, right? So one, the supply imbalance are addressed in some of this market. Then we also continue to have housing shortage in the United States, right? So then you get affordability issue as well with home ownership. Overall, that's going to provide a strong tailwind for this sector, Phil.
Yeah, and actually on this slide here, if you're looking for signs of a momentum switch, I guess, Robbie, between Q4 and Q1, in those yield impact metrics, you had a mixed set of results back in Q4. Pretty much now everything across all those CBSA markets adding to value. So it certainly feels as there's a bit more optimism being priced into the sector. There is a mix of the results on the cash flow side of things. So in those non-gateway markets that you called out down the bottom there, Robbie, that declining cash flow on the next slide can be traced through to some reductions in market rent. So picking up to your point, some affordability issues and near-term supply. Also some trimming back of the projected growth rates, and also picking up on that right-hand column there, the fact that kind of near-term costs are still rising in some of those markets more so than near-term revenues. But generally, to your point, as if there's definitely more upside coming through in the apartment sector. Let's pivot across to the industrials, which is possibly one of the most topical sectors in the wake of April the 2nd. Themes here to the end of March are very similar to recent quarters. So most markets now starting to post some pretty encouraging numbers, returns coming in most north of 1.5%, and that's income plus positive appreciation. Some notable standouts in there: Miami, Atlanta, or inland, Houston, Dallas, also to that other grouping. The outliers, though, are here, those West Coast markets, San Francisco, Seattle, LA, and the Inland Empire, all coming in below the sector average. In terms of a momentum swing between Q4 to Q1, again, as with apartments, we're seeing a wide array of positive yield effects on the card. What's held back the markets, though, down the bottom, those West Coast markets, is a tapering back of those cash flow projections. And if you relay that through, that decline in the cash flow can be directly traced through to declines or further declines in market rents. Contrast that with the likes of Miami, Atlanta on the East Coast, more central, Houston and Dallas, where markets are very much on the rise in that respect. So Robbie, your thoughts there on the contrasting fortunes, but then especially maybe in relation to the aftermath of April the 2nd. I know that you've been doing some work with our research team around that. So across to you to provide the extra detail there.
Sure. I think all these numbers are prior to our April 2nd, right? So if you see as well, the West Coast already experienced challenges, right, with market rent and near-term supply issue. The tariff effect, Phil, is still a little bit unknown, but we know the uncertainty surrounding tariff will make inventory and business planning difficult for most companies, right? So we've seen a pull forward in inventory in first quarter, right? So as many retailers was already anticipating this tariff, right? So you see that already reflected in earning call, including Amazon. You see that as well in March retail sales, right? Grew stronger than expected. Part of it is due to many of the items as well that they're facing stiff tariff, like so furniture, clothing, and general merchandise, right? So while many of the reports have not shown the impact on tariffs, early indication from Port LA already starts showing some part of it, right? So if you look at last week, there's only 16 vessels coming in. I think this week expecting only 15 vessels, right? So that's down like 14% and 36% for the same period last year, right? So, and you look at the freight rate as well, right? So that's also been dropping, right? So jewelry world container index falling to 2,100 for 40-foot container. And early January, there's 4,000, right? So that you can see the significant drop in freight rate already, right? So, and tariff impact already shown as well in most recent export data. I think the CNBC reported a couple of days ago, right? So U.S. export to China by ocean freight fell to around 5,000 TEU in April, right? So in comparison, that was 22,000 TEU in March, right? So in U.S. export worldwide as well by ocean freight dropped significantly in April. Like we talked about 57,000 TEU. Same comparison like in March is 265,000. You look at the last basically 3 months in the first quarter, and all of them is about 200,000 TEU, right? So I think the big question now, if it's transitionary or it will persist longer, right? So that's the kind of the unknown right now, right? So to analyze kind of potential impact to various different port, I think our research team have put several slides. That's actually really interesting, right? So we have broken down the import to various port to the regional trading partner, and also survey on the industry, on the manufacturing, the impact. So we have to thank Omar and our research team for the excellent analysis, Phil. So you go to the next slide, Phil, right? So I think on this slide in here, right? So basically we kind of going through, we know the tariff are negotiated on a country level, right? So a different port tend to kind of have uneven trade and import export like with different region of the world, right? So to analyze that impact, we have broken down kind of port by region to kind of see the exposure to regional trading partner, right? So in here, it kind of show West Coast have the largest exposure to Asian trading partner with 77% of 2024 import come from Asia, right? So then we kind of look at as well, like how is manufacturing side on the survey, right? So what is the impact on the tariff, right? So 67% that indicate negative impact. And most of them going to come from higher input costs, then will pass through to end consumer with higher selling prices, then will impact also the profit margin. Again, overall negative outlook, right? So Phil, can I go to the next slide, Phil? Right. So, and then I think that the team then basically drilled down to various different ports, right? So our research team have broken down the top 25 port cities, trying to see the different trade-related impact, right? So if all tariff really go through, right, the West Coast port, excluding San Diego, will be the hardest hit, right? So because these are the most China-linked trade, right? So look at example for LA, right? So 87% of import from LA come from Asian region, Phil.
For the east and the west, so east and the south is far more moderate.
So I think the East Coast side, you can see the Savannah might be the hardest hit, right? So, but again, 55%. But again, I think the Asian countries are all the same as well. Some of them, we know that India tend to shift to the east, right? So I think there's a lot of shift on kind of supply from China to India. So in the long run, maybe better off on the East Coast, right? So Midwest and South, not as bad, right? So I think overall, Phil, I think it put a lot of pressure, right? So I think we talked about LA and Inland Empire already, right? So because of the risk, I think that we're drilling down on the next slide, right? So we're drilling down to these two markets, right? So again, I think just because we know that we already kind of analyze it, West Coast will be impacted more. We talk about it, Inland Empire and LA is kind of more impacted. So we plot occupancy, remaining lease term or WALT, right? So and rent, contract rent, and market rent versus the national averages, right? So and look at occupancy, right? So LA and Inland Empire are basically in late 2021, early 22, and even beforehand, it's pretty close to 100% occupied, right? So it's always trended above national averages, right? So, and then starting in late kind of 22 and early 22 and early 23, you can start seeing that occupancy start to decline. Look at where they are now. They are below national averages. And the other thing as well, remaining lease term, the WALT are also lower than national averages, right? So again, with the challenges in near term, that's provide a lot of challenges as well on what market rent will be, right? So yes, contract rent's up. We know that, as you indicated, Phil, right? So as kind of contract are significant below market, so rollover is good in capturing the upside. Again, I think in some cases the risk on model is good in here, but the near-term uncertainty, as we discussed earlier, with the port exposure, it definitely create kind of challenges in that market, right? So we understand not all industrial assets are created equal, right? So some of the more infill and cater to local economy will hold up better. We know there's over 23 million in Southern California region, right? So definitely you need that to cater to some local economy. We do find there, right? So, but it was more for distribution, export, import. That the asset might feel more challenges, right? So, and then kind of looking at LA and Empire, right? So I think people ask what causing it. So part of it is you look at direct vacancy in that two market. It's like 5.8% and 5.4%. Look at availability rate. I think that they're 11.8 and 8.2 respectively. Again, depending what market report you use, but regardless what it is, it's pretty high, right? So, and it's so different than 3 years ago when this market basically call it like 1% or even less than 2% overall, right? So leasing market have been generally stagnant, and this uncertainty making it even more uncertain, right? So I think that's kind of one of the reasons declining cash flow, Phil, in LA and Empire, kind of negative return. I think the uncertainty with the tariff definitely put a lot more pressure on Inland Empire and IE in the near term, Phil.
Yeah, great. I mean, that's fantastic extra analysis there. So also a big thanks to Omar and his research team for helping us put all that together. But yeah, further kind of backing up. I mean, even when we're seeing in March that variation between the West Coast and the Central and the East Coast, that feels like that may continue to widen and include some headwinds associated with the broader industrial sector. So yeah, certainly continue to watch those numbers in the 3 months ahead. Let's move across to the offices now. Feels like the sector there's been a lot of narrative around, but just to recap on those 3-year numbers, that's really the period of decline. And here, most challenged markets over that period have been those main gateways. You know, surprise to folks on the call, see Seattle, San Francisco, Chicago, DC, New York in the red zone there, while the more Sunbelt spots where there's been great utilization of office space have proved more resilient. Return-wise, they're still negative, but less so. In terms of any momentum swings, New York looks to be steadily coming back into its own. Returns there ratcheting to 1.2%, so there's some positive appreciation in that number. LA also up in the green in positive returns, and also a positive return there for the year. In terms of some of the more challenged spots, DC continues to suffer, which no surprise there. Chicago also remains muted. San Francisco also at the lower end of the hierarchy. But that overall step up in returns that we noted really at the start, that negative to positive return the office market went through between Q4 and Q1, and you can then see that positive returns, those positive returns being posted in pretty much most of those metropolitan markets. Looking at the kind of yield and cash flow aspects of the appreciation, that momentum swing, if you're looking between Q4 and Q1, looks to be certainly embedded in that cash flow metric. Yes, there's less pullback on yield, but it's the cash flow metric, which is now posting positive gains in pretty much all markets, the exception being DC and San Francisco, but generally a kind of a clear momentum shift in that regard. And within that cash flow metric, what stood out for me, Robbie, was here, that improvement in market rents that we're starting to see coming through, and also a tick up in those kind of growth rates, those 10-year projected growth rates. So definitely feels there's a bit more optimism starting to come through in the fundamentals there, Robbie, albeit from a relatively low base. Your thoughts around that?
For sure, it definitely feel like bottoming, right? So we have been hearing much more positive news, right? So everybody getting sick of hearing negative news from the office, right? So now we start hearing a lot more positive, right? So I think part of it is benefit from the return to the office mandate across America, right? So which is much more prevalent actually in the financial service industry, right? So that's why you can see New York's performing better than San Francisco, right? So granted, some of the tech companies have also implemented return to the office mandate. We saw that Amazon, Dell, Tesla, right? So but it's generally still slower momentum in the tech sector, right? So, and I think you can see as a bifurcation of the tech city, right? So Seattle performed better than San Francisco because part of it is the Amazon back to the office as well, right? So Washington, D.C. have its own challenges. We heard about federal employee cut there, right? So that's kind of challenges on the Washington, D.C. side. I kind of look at it, return to office will kind of continue to flow through 2025, right? So as company as well, trying to figure out the usable space with the influx of employee, right? So I think overall, we start seeing positive absorption in office, especially in New York, right? So New York and Sunbelt market generally have higher utilization, still down compared to 2019, but we definitely see improvement. We also see bifurcation on quality of asset, right? So in terms of leasing and pricing, right? So high quality of asset continue to take higher share of leasing activities. On the financing front as well, we see improvement, right? So on the financing cost of the office, like so CMBS market have improved, and then unsecured market have improved for the office REITs. So I think overall, all these things kind of bode pretty well for the office market, Phil, on the near term.
Yeah, okay, that's be encouraging to hear. Thanks for that, Robbie. Let's then just wrap up and get into the retail sector. I know you've done a little bit more analysis around this in the wake of April the 2nd, but for now, retails are the stronger performing of the major food groups. It's the larger destination malls. These are the Q1 numbers, and the fashion and specialty centres have led the rankings. Probably maybe that's a sign of a improved consumer confidence. That might take a slight jolt now. If you reverse back these numbers on a full 5-year basis, so back into some of the more challenged times for the retail sector, it's then the grocery anchor, the neighbourhood, the community centres, and also those power centres with the discount retailers that prove to be more resilient when you back into the more challenged times. So, Robbie, how do you see the kind of hierarchy plus, I guess, the general health of the retail sector playing out in the near term going forwards?
Sure. I think as you can see from prior slide, right, so super regional mall are seeing improvement in cash flow. I think one of the main reason is the role of the COVID leases. I think most of us forget about COVID exists before, right? So, or the pandemic situation before. I mean, as you know, the retailer was impacted directly with the shutdown, right? So during the pandemic period. So a lot of leases signed during that time is kind of generally lower in the market. Feel like more temporary leases type deal, right? So a lot of percent in lieu, a lot of kind of lower kind of base rent with no percentage rent. So, and however, as the retail sales recover, and in many cases have improved significantly, right? So these leases are now rolling to more your typical leases that more commercial with sales, right? So that's why we're seeing big improvement on cash flow front. So both the minimum rent and percentage rent. And again, you see as well throughout all categories, right? So there's definitely improvement in fundamental there generally, right? So I think the big question is that all of this are before Liberation Day, right? So many clients are now asking what happened now with the tariff, right? So I think there's two factors we can look at that might impact retail, right? So I think the increase of recession risk, right, and lower GDP, right? So how are this going to impact sales and consumer spending? We all know rent in retail generally also correlate with sales, right? So, and the second one is as well, we kind of look at it the retailer point of view, right? So what is the tariff impact with the retailer, right? So not all tenants will be able to mitigate higher costs, right? So, and also with the tighter immigration policy, there's also impact on the labor costs on the retail side. We know historically have been kind of a lot of bankruptcy news on retail, right? So, and they just came out from it. Now the question is how they mitigate all these higher costs, right? So if you go to the next slide, Phil, right? So you kind of go to basically more on the more sentiment survey and kind of the NCREIF data later on as well, right? So I think if you look at it, the sentiment survey, right? So University of Michigan released a final index of consumer sentiment for April, right? So the index declined 8% month over month to 52.2. So slight improvement from initial readout of 50.8. But this reading is still the fourth lowest in the history of the data set, right? So not only that, respondents also expect the price to increase by 6.5% over next year, right? So the highest since 1981. And long-run inflation expectation over the next 5 to 10 years have reached 4.4%, which is the highest since 1991, right? So again, one of the first major sentiment index for April, definitely showing kind of growing consumer pessimism, right? So now 44% of Americans believe that they will be worse off a year from now, right? So I think weaker labor market expectation concerning about higher prices are potentially leading to household raise for this lower real income, right? So this might also be kind of resulted with on the retail foot traffic, right? So and potential double hit, right? So if it's international visits to the United States declining, I think that overall we have to start looking at bifurcation according on asset type and how this will play out, right? So that's why we kind of go to the next slide, Phil, right? So I think on this slide, we kind of look at it like, how is the retailer feel impact on tariff to the business, right? So you can see 73% indicate negative impact, right? So similar to manufacturing survey on industrial before, we talk about higher input costs, which then will pass on to customers higher prices, then will also result in lower demand, right? So knowing all this risk, we're trying to kind of plot it, the expanded NPI data set. We're getting total income on retail centered, right? So on the right side there, trying to see which one will hold up better if recession do happen, right? So I think that, again, I know that a lot of respondents feel that the second best performing could be retail. I think that the retail have been taken big down. I think with uncertainty, we're trying to understand which one will hold up better, right? So you can see in here, the strip center, which include a lot of grocery anchor, have more steady income, right? So, and many expect that grocery anchor will hold better as well with recession, right? So similar to, you see the trend, the pink bar there, right? So they tend to hold better during recession. But overall, I think cautiously, we kind of look at it, retail still affected by overall macroeconomics, right? So, and consumer condition, which is kind of deteriorating right now, right? So, and we definitely continue to monitor in the following quarter, Phil.
Thanks. So a lot of extra detail there, Robbie. Thank you so much. And thanks again to our research team for assisting in pulling all that information together. We're pretty much towards the close of this. So just a final closing polling question. And we'll talk a little about some product side of things, and then we'll get into any Q&A. So Robbie, do you just want to wrap up with this one?
Yeah. So what do you expect the total unleveraged return to be right in 2Q, right? So I know we talked about 1.2% 1Q. Is it going to be stronger than 3%, i.e. stronger improvement? Or is it going to be similar or gradual improvement, so 1 to 3%, which means appreciation 0 to 2%? Or is it dropping back, right? So less than 1%, basically appreciation 10 bit negative, right? So we'll give about 30 to 60 seconds, right? So Phil, what will you pick after all this discussion, right? So
after hearing you talk there a little bit, Robbie, maybe I'm pivoting between B and C, but I don't feel like I'm going into A at this stage.
Yeah, I think B seem to be kind of, again, there's uncertainty, right? So, but I think kind of fundamental still relatively strong. So I would kind of pick the B, right? So I think it's gonna be similar. Let's see what the result there. Yeah, 70%. Pick definitely a B, but that's definitely a lot more now. The thinking is gonna drop back down just because uncertainty here, Phil.
Okay, well, thank you everybody again for participating in that. As I say, the slides will be sent out. There's some summary points that we've covered off today around the key movements that we've noted. Just a quick word on the product side within our organization. So this quarter we released our benchmark manager product, which is part of our Argus Intelligence suite of products. So the type of narrative to provide on a comparative basis against these results that myself and my team provide to clients who already passed their data through to NCREIF, take that up to a portfolio return. We're trying to make the analysis around valuation movements more accessible to all of our clients, both on the advisory and the wider software side, and also improving that kind of user experience for the folks that have been working with us from a performance comparative analysis. So our performance benchmark manager has been released this quarter. We'll be showing that to our clients in the weeks ahead. But it really is there to enable clients to build up a narrative on the movements of values in their portfolio versus a wider data set, following much the same flow of what we covered off today in this webinar, down to sectors, down to CBSAs. What influences movements in values? Is it yield? Is it cash flow? But also bring in the attribution aspect into interpreting why a fund might be different from a wider benchmark data set. So if you're interested in receiving this type of analysis on your portfolio and you've not yet heard about it, do get in contact with your advisory or your client representative, and we'll certainly be happy to set up demonstrations to folks in the weeks, months ahead. But on that, just getting into any Q&A that might have come through, Robbie, because we've got a few minutes just to close out.
For sure. I think that, yeah, if people have questions, please incorporate them into the Q&A box, right? So I think the first question can always be consistent, Phil. Like, so when is the breakout for other property type, Phil? Like, I know that's NCREIF talking about different breakdown of property type or subtype, right? So when are they going to start flowing through to our analysis?
Okay, right. So that's already available for those folks that have access to the valuation data sets in DataBridge. So we've already aligned with the NCREIF property types there. I know the NCREIF query tool goes into that level of detail. We're just working with the folks at NCREIF to make sure that these ODCE portfolios and the files we're getting on those align with those property types as well. I'm hopeful next quarter we'll have all that fully working, and so we'll be able to introduce more of that narrative into the next quarter's results. But to look at the valuation metrics on that basis, you can already go through into our DataBridge product for that.
Yeah, and basically as well, there's question associated with basically, I think that again, people coming in as well, right? So and let me kind of reading through it real quick. So, but yeah, this question basically, again, I think the with uncertainty, have we seen the impact on transaction, right? So have we seen basically pullback on transaction? I think that generally as well, I think from what we see in the market, we're trying to talk to different clients, right? So a lot of transactions still going through, right? So we didn't see too much of an impact, especially if it's residential or even retail, right? So we see a lot of transactions still going through. I think that some of the industrial might be put on hold, right? So depending on what industrial is, right? So I think the West Coast industrial, that's what we heard a lot of cases as well, right? So a transaction, maybe a first round before April 2nd, but the second round, a lot of the investors are putting that on hold. So it definitely a lot of question on that basis, on that side. So I think that the question is, what level of job losses would require to cause a reversal in apartment performance, right? So again, I think that's a little bit of the unknown, right? So it's kind of like generally, you're correct. Basically, there's a lot of apartment sector do tie to basically the employment growth, right? So, but if you look at the unemployment, are still pretty strong right now, right? So. And then the other thing as well, like this question mark is how long is that impacting a lot of different market, right? So I think macroeconomic impact do impact all sector, right? So as of right now, based on a lot of our discussion out there, a lot of investors generally still talk about the strong fundamental, right? So I think it's definitely something we need to kind of monitor over the next 90 days. What did that look like, right? So there's one question about what do you think valuation have thought? Basically, have we bought them, right? So I think that if you look at the valuation perspective, it seemed like we have kind of reached the bottom. Granted, there's a lot of cases as of first quarter, right? So there's a lot more question now is basically with the uncertainty in today's market, right? So after that, the April 2nd, right? So I think something we kind of continue to monitor. Like, so a lot of our discussion with a lot of investors out there that they're basically still cautiously optimistic, right? So definitely going to continue to monitor what's the impact on tariff, what's the impact on economy, right? So basically, I think that that's pretty much the question that I have right now, Phil. I know there's with the timing issue. We want to kind of
sure.
making sure that the overall.
If other questions do come through,
other questions, we're going to address it later on, right, Phil?
And also, I mean, just to again a plug to Omar and his research team. Thanks very much for the added intel you provided, and folks on the call. I do encourage you to go onto our website and read some of their white papers. So they definitely add more breadth to the narrative and continue to release great research material almost on a weekly basis. So, but more importantly, thanks everyone for dialing in today's call. If there's interest in getting more comparative analysis around these results, do contact us. And for those folks that we're already provided that narrative back to, we look forward to talking to those portfolios in the weeks ahead. And thank you, Robbie. It's been a pleasure to run through that with you today, and thanks for everyone for assisting in the background.
Perfect. Thanks, Phil.
Thanks a lot, everyone.